Over the last 10 years, US stocks have absolutely kicked ass over foreign stocks, and this has many investors wondering, should we even bother allocating to international foreign stocks? Well, I wanted to look at this a little bit deeper. So first of all, let's start with this chart right here, which shows the performance of US stocks versus global stocks, excluding the US stocks, going back to the year 1986, and we can see US stocks have, over a longer period of time than 10 years, still absolutely decimated global foreign stocks, right? The total compound annual return of US stocks over this time period was 11.05%, and the compound return of global foreign stocks, 7.08%. Meanwhile, the foreign stocks had a higher standard deviation, meaning they are more volatile than the US stocks. So you were taking on more volatility, more risk, for a lower return. Historically, you have. Okay, and with that, S&P 500 companies generate a substantial amount of their revenue from foreign countries. So this is typically used in the argument to make that, well, maybe we should just invest in S&P 500 and we're going to get exposure to all of these markets, or at least the sales revenue from these markets. This chart here from 2015 shows that US generated revenue was about 52.2%. This chart here, generated in the end of 2017, or based on the end of 2017 data, December 29th, 2017, shows that S&P 500 revenue was about 71% US based. So there is some discrepancy between this, and I don't think there's an exact hard number on where the revenue from the S&P 500 is actually generated. I guess, looking at these numbers, we could say it's somewhere probably between 50 and 71%. It does change year to year. But again, it does get you some exposure to other countries. So therefore, we don't need any stock exposure to other countries. Now, let's go back to where I was talking about the volatility and returns. If we plot out the efficient frontier here, and this is using data from 1970 to 2008, it shows that the highest risk return profile using the efficient frontier method would be right around here, 70% US stocks or 60% US stocks. So a nice tilt to US stocks is going to get you the highest return for the volatility that you are taking on. Now, keep in mind, this just shows us through 2008. So this, already has 13 years of data not accounted for in the chart. And in that time period, if we go back here, we can see that US stocks just kind of going up to the moon, whereas foreign stocks, in the last 10 years really haven't done much. So if we were to recreate this on today's data, it would probably say, 100% US or 90% US stocks. It would be even more highly skewed towards the US side of things. All right. And then finally, you can also make the argument that, foreign stocks are very highly correlated to US stocks anyway, so therefore we don't need a very, large exposure, if any, to foreign stocks because they all do the same thing anyway. So let's just look at this here from 1986 to 1996. We can see that the correlation to the US stock market was 0.39, okay, of foreign stocks in this period. Now, if we go to the last 10 years, mind you, this is actually 11 years of data. We do that. If we selected 2012, it would be 10 years of data. But we're going to select 2011. We're going to get 12 years of data here. Or 11 years of data. Right? The correlation between foreign stocks and US stocks is 0.87%. That said, the US stock market returned nearly 3 times what the foreign stocks did in this period. So there's a solid case here that, just going with US stocks only is the way to go in the future. But that is the big kind of breakaway here, and that is in the future. Those three keywords. Is that 3 words, in the future? Yeah, that is 3 words. Those 3 words, in the future, is really the takeaway because everything that we're looking at here is historic, right? And that's something that trips up a lot of people when they're analyzing things, and they look at hindsight data. Because hindsight is always 20/20. You look at it and you're like, okay, well, that was the thing to do. when in reality, you kind of got to look at some things going forward. And for that, I'd like to look at the CAPE ratio. Now, the CAPE ratio has been shown to have a high correlation with forward 10-year returns, meaning that the lower our CAPE ratio is, and the CAPE ratio is the cyclically adjusted price to earnings ratio, basically a price to earnings ratio that adjusts for inflation over a period of time. In this case, I believe it's 10 years prior. But when we look at this here, we can see, going back to, we don't have data from this point on for the forward returns, but what we can see here is the blue line being the CAPE ratio and the green line being the 10-year forward return. So when the CAPE ratio is really low, the 10-year forward returns are high, right? And as the CAPE ratio gets higher, the 10-year forward return goes, in some cases up, but in some cases it also goes down, right? So there's some kind of correlation here between the CAPE ratio, or at least there has been historically in predicting forward returns. Rob Arnott does a lot of talking on this, or at least a few years ago he did. 2016, 2017, he was talking a lot on the CAPE ratio. I haven't heard him say much about it recently, right? But what we can see when we look at this stuff compared to foreign stocks is that the CAPE ratio of US stocks is incredibly high. CAPE ratio of US stocks, this is through the end of 2020, so it's a year out now, but it was about 30 right here, whereas foreign stocks were down at about 17. So they're nearly 50% discounted in valuation than US stocks. So what this means is that when you buy foreign stocks, you are getting more profitability, because this is a price to earnings ratio. You are getting more profitability for the amount of money that you invest. And if we look at historic data, investing where you're getting a lower CAPE ratio and where you're getting more for your money or more earnings for your money has historically been a good thing and pointed you in the direction of outsized returns. So the CAPE ratio could make the case that foreign stocks are going to have better returns over the next 10 years. That said, I've been following this, and basically since like 2014 or 15, all metrics of CAPE ratio or any kind of strategy formulated around the CAPE ratio would say, hey, put all your money in foreign stocks or emerging market stocks. But since then, we've been 5, 6, maybe 7 years since then. At this point, you've basically been on a pain train. So that's the thing with value investing, is it's a pain train, right? Like, you got to wait for that value to actually be realized you got to wait for that value to actually be realized to see some kind of returns, and you're kind of going against the market in many cases. All right. Finally, one other thing we have to consider is the composition of global foreign stocks versus US stocks. Where's the growth at? Now, interestingly enough, when you look at the total, this is Vanguard's total international stock index fund right here. The composition of it in the sectors shows some interesting things. They are very heavy in their consumer cyclicals, financial services, and industrials. These things make up, a big part of the economy. Technology is in there as well, but it's not nearly what it is in the U.S. All right, so if we look at the S&P 500, we can see a huge amount allocated to technology and then communication services, whereas in total international communication services, this is very highly correlated to tech. This is where Zoom would be in, and companies like that. You get much more exposure to it. So you can also make the argument, and some investors are making the argument that, well, hey, the US has exposure to the high growth sectors, or much more exposure to the high growth sectors like technology. Therefore, I'm going to invest there. So in the future, these sectors are where the growth is going to be and ultimately drive returns. So the S&P 500 US equities is where I want to sink my money. So there are the cases on both sides of the spectrum for going 100% US or having exposure to foreign stocks. I think the big justification for exposure to foreign stocks is, hey, they've done so poorly. You're getting a much higher return on earnings, or you're not getting a much higher return on earnings. You're getting earnings at a lower valuation with foreign stocks. Therefore, you'd be poised to do better over the next 10-year period, looking at some of these CAPE ratio strategies. Personally, I'm kind of leaning a little bit more towards US stocks for my own allocation, and that's because I follow more, or I don't follow, but I invest heavily with Vanguard and a lot of their life strategy funds. I do like their life strategy funds, and they tilt more towards the US. So what do you guys think? Are you going to be sticking with US stocks going forward? Are you going to be allocating a little bit to foreign stocks or a lot to foreign stocks? Let me know in the comments below.